Alright, so in this video I'm going to cover the concept of hedging. I usually do this on once in a while on a lot of my trades where I think it has the potential to go in both directions, and I am betting on one direction, but at the same time I see an opportunity to straddle the trade, and the benefits of that is what we're going to cover in this video. So this USD Jappy trade, you guys can see here, this is what the chart looks like with the executions marked up on the chart. We got a long that has already triggered in. Our take profit for the long is right here. Our stop loss for the long is right there. And we also have order in, which is a pending order, which has not triggered on the USD Jappy, which is a short in case it starts going down. Our short's going to get triggered in here, and then our take profit for the short is right there, and our stop loss for the long is right here. So now why do this? Right? Why do this? What is the benefit of doing this? And I'll tell you what is the benefit. The benefits are it really cuts the risk on this trade. And how does it cut the risk? Let's go over that right now. All right, so on the long, so if we hit our take profit, okay, on the long, we're gonna make about 124 pips, okay? And if we stop out on it, our stop loss is also pretty much about 120 pips, okay, on the USD Jappy. And on the short side, our take profit is about 114 pips, and our stop loss is about 96 pips. So now let's see what happens. Now let's say USD JPY from here never goes down, never triggers a short, but just keeps going up. What's going to happen? What's going to happen is simply this trade, we're going to end up canceling it if it never triggers. Yeah, and we're going to hold the long, and the long is going to make us 120 pips. So scenario one, short never triggers, long keeps on going, we make 120 pips. Okay, let's say scenario two, it keeps going down, and the short gets triggered in and the long gets stopped out. All right, so long gets stopped out, we lose 120 pips. Short gets triggered in, and the short target is pretty much right below our stop loss for the long, and the short ends up making 114 pips, right? 114 pips. What's going to happen then? Net result, we're going to lose 6 pips. Okay? So we're going to lose 6 pips. So if it keeps going up, short never gets triggered in, we were making 120 pips. If it just drops like a rock and short stops out, we're going to lose 6 pips. All right? And then scenario 3. Scenario 3. The short, the USD Jappy goes down a little bit, triggers our short in, right? So the USD Jappy, let's say, goes down a little bit, our short gets triggered in, but it immediately starts bouncing. What's going to happen then? The short's going to get stopped out, and we're still going to be in the long, yeah? So on the short side, we're going to lose, let's say, 96 pips, and the long is going to end up making 120 pips. So net result, right here, net result will be equals to 24 pips. Okay, so now do you guys see how we've really limited our risk? It's amazing. Yeah, it's amazing. Look at these scenarios, guys. Look at these scenarios now. Scenario 1, we're either going to make 120 pips, either we're going to lose about 6 pips, or we're going to make 24 pips. Now that makes this trade easy and no-brainer. Okay? So that's why I do this on a lot of positions where I see the potential that it could be hedged and the potential that this trade could be straddled, right? And I like to straddle them a lot because now I've basically cut my risk to nothing so far, right? So far I've cut my risk to nothing. I'm either going to make 120 pips if it keeps going up. If it goes down and just stops out on the long, we're going to lose 6 pips because the short's going to start making money. And if the short gets triggered in and then stops out and then long keeps on going, I'm still going to net out 24 pips, right? And the only way we're ever going to lose in this trade, if the short triggers and then it stops out and it goes up a little bit and the long also triggers, yeah, in that case, yeah, sure, we're going to lose a little bit of money, but the odds of that happening is unlikely, yeah. And if that happens, which it can, the thing is then you don't even want to trade that market anyway. So in that case, what's going to happen then? Yeah, we're going to lose 120 here, 196 here, so we're going to lose about 220 pips. But really, these are the 3 scenarios that are going to play out. The 4th scenario is possible, but it's super, super unlikely, right? The 4th scenario is super unlikely. That indicates a choppy market, and based on how the pattern is, it's gonna go either way. It's gonna go up or down, right? So it's gonna go either way. So now what this basically does, this hedge is, it is a bullish hedge. It is a bullish hedge. That means we're still bullish on the USD JAPY, but we also want to cover our, back ends in case it starts going down. So the bullish hedge is basically betting on USD JAPY to go up. If it goes up right now, you make 120 pips, scenario 1. If it goes down a little bit, short gets triggered in, and then it keeps on going higher, we're still going to make 24 pips, right? And if it just drops like a rock, we're going to lose 6 pips. So our risk is so limited. We have these 3 scenarios, and 2 scenarios are going to make money, and one of them is pretty much break even. So that's why I hedge. And you can go back on our Twitter stream. You will see I've done these hedges in the past. I've done them a lot on USD Swiss franc. In last month, I think we did a USD Swiss franc long, and we also did the short. And pretty much I did them both at the same price. Right now, what that is, it's basically betting on a move, either way, to the upside or to the downside, but it's betting on a move to happen. What happened? This is the funniest thing that happened though. USD Swiss franc never put in that big move we were expecting, okay? But it dropped. What happened? We were still in our long, okay? Our long stop loss was, let's say, right here, okay? It held our long stop loss. It hit our take profit for the short. So now we covered the short as the short hit our take profit, and we're still in the long. It ended up coming all the way back up, and then it ended up hitting our take profit on the long side. So we ended up making money on both the short and the long, and they were both taken at the same price. So now that happens too a lot of times, right? You're basically hedging the move. And another scenario why I hedge sometimes is if I'm expecting a move one way in a big direction. So let's just say Euro US dollar. I'm expecting this to, which I'm not, I'm just using this as an example. If I'm expecting this to explode either direction, right, I might do a hedge, which is I might go long and short at the same price, okay? Betting on the direction that it's going to make a move. Let's say my short stop loss is right here, my long stop loss is right there. Let's say it just boom, some news comes in, NFP comes in, it explodes to the upside. Short gets stop lost, right? We lose, let's say, 50 pips, and the long keeps on making 100 pips. Net result, let's say 50 pips. Now let's say it starts dropping like a rock, long gets stopped out minus 50 pips, and the short keeps on making money. Short, let's say, makes 100 pips. Net, you're gonna make 50 pips. So here's another way you can hedge. Now these are more advanced concepts. Now, unless you're following me, then that's fine, but don't try and do these hedging concepts on your own right now. Maybe practice them on a demo account and start creating these scenarios. And these scenarios will really help you hedge your portfolio and capitalize on moves in either direction. So unless you're following me, which is fine, if you're doing it on your own, make sure to test these on demo first before you get used to it, because not every trade is a hedge. Not every trade is meant to be hedged. Some trades are just meant to let them go. Some trades you can find opportunities to hedge yourself. And that's what we did today on the USD JAPY. All right, take care, guys.